Morning, everybody. It's Tom Sheridan from Seven Investment Management. I'm here today with Henrietta Grimston, with Chris Justham, and with Michael Fajardo. For those of you who are new to these webinars, we periodically like to get together in a fairly informal setting and try to let everybody know what it is that we're thinking and what we're doing in the portfolios to help protect people's capital and gain the expected returns. Normally, when we're managing the money, we're primarily considering macroeconomic activity, market valuations, but more and more these days, politics keeps getting in the way. And that's really going to be the subject for today's webinar. Before we get started, Michael, a couple of housekeeping details.
Thank you, Tom. As always with our webinars, we're delighted to take questions from you. And so I just thought I'd explain briefly how you can do that. In the bottom right-hand corner of your control panel, you'll see the question. You'll see a cross next to the questions, where it says questions. If you click on open on that, you type your question in, and then you just press send. That will come through to us, and at the end of the webinar, I will facilitate the question asking to Tom, Chris, and Henrietta. Back to you, Tom.
Okay, Mike. Thanks very much. Now, we talked about political events affecting markets, and certainly the major recent political event was Brexit. And boy, did we get a series of unexpected outcomes. It was only hours before the votes were tallied. Markets were telling us that Remain was going to be the outcome. The bookies were telling us that Remain was going to be the outcome, and of course we now know that that was not the outcome. Surprise number one. Then we had Mr. Cameron submit his resignation. In the light of Brexit, probably not totally unexpected, although there was a Save Dave campaign shortly beforehand. What was a very unexpected outcome was, of course, Boris being sidelined through largely the efforts of Mr. Gove. So we expected Boris to emerge as a leader here, and he turned out not to be in that position. We expected a European reaction, which was very different than what we got. We thought that if Brexit happened in the UK, that could be the first domino to fall around Europe, and indeed it triggered the opposite reaction in Europe, where many of the people probably looked some of the mayhem caused by Brexit, and votes swung the other way against that sentiment. Markets themselves were a big surprise, although we had initial sell-offs. The recovery of markets, particularly outside of the UK, has been quite strong. And then, of course, we have Theresa May herself as not the candidate that we thought would emerge, and we'll talk a little bit about how Theresa's doing in the early going. So, so much for what happened in Brexit. Just by stage setting, Chris, give us a quick recap of what happened around the Brexit day.
Thanks, Tom. So the two key areas that we saw an immediate impact after that unexpected leave vote were the currency markets as well as the equity markets. Just looking here at the pound versus the dollar, beginning part of June up until to date, and the big headline, I suppose, that we all read in the newspapers was the pound weakened dramatically against the dollar, both on the day of the results and on the following Monday. So it actually fell 14%, so quite a precipitous fall. It's important, though, to look at this in context. The pound is actually the lowest it's been since the 1980s now. So if you look at the far right-hand side of this chart, you can see sitting around 131 now. That's the lowest it's been since the 1980s, where we left the exchange rate mechanism, and obviously we saw the carnage that ensued as a result of that. And some more context, if we actually look at the pound against the dollar, it's halved in value from about 40 to 50 years ago. So the trend has been that it's been moving downwards. Looking at the equity market impacts now, though, there are two lines on this chart. The green one is the FTSE 100 and the white one is the FTSE 250. The FTSE 100 represents the 100 largest companies in the UK, FTSE 250 medium-sized companies, and as you can see, they behave slightly differently. So FTSE 100 did fall initially. We saw that immediate impact similar to the currency markets. But what we can also see as well is it's rebounded since, and the Wednesday following the vote, it rebounded quite dramatically. So we've got to the point now where we're further ahead than where we were before the vote. Conversely, what we can see from the FTSE 250 is that it fell further and hasn't rebounded anywhere near as far as the FTSE 100 has. Now, there's actually a good reason for that. The markets seem to have interpreted this as a regional event rather than a global event. And we've got here these two pie charts, left-hand side FTSE 100, those larger companies, right-hand side the FTSE 250, those medium-sized companies. What we can immediately see is, if we look at the constituents of the FTSE 100's combined revenues, i.e. where they make their money, 3/4 of the FTSE 100's revenues come from abroad. So as we said, if it is a regional event, if you've only got a quarter of your earnings coming from the UK, you're not going to be as impacted, which is why we've seen such a rebound. Also, they've had a nice boost from an accounting point of view from revenues coming from the dollar. Conversely, where the FTSE 250 is concerned, those medium-sized companies, they've got comparatively rather more earnings coming from the UK, more closely aligned with the UK economy, which is why we saw that fall further and not rebound as far.
Chris, thanks very much. And that emphasizes one of the first surprises that we saw, which was the rebound in equity prices, particularly in the FTSE 100. And what we infer from that is that the market, as Chris said, is interpreting Brexit as not a global or systemic event. And that was one of our big questions going into Brexit. So Hen, having said all of that, what do we actually do in the portfolios?
Well, you mentioned at the beginning of the presentation that, of course, the favourite outcome was Remain, not necessarily by a huge landslide, but the polls that we saw released in the run-up to the event and even the odds that the bookies were putting on the outcome all suggested that Remain was going to be the scenario that we would see. And actually the markets themselves had reacted to that in the days running up to the referendum, so we did see an improvement in both the value of the pound and the FTSE itself. But of course, you never really know the outcome until you've got that definite result announced. So with that in mind, and given the improvement in the markets, we saw there potentially a risk to the downside should we have a shock result of the referendum. So we built in place an insurance policy, and that for us was the US dollar, a safe haven currency and one that obviously is not closely linked to what's going on here in the UK and of course across in Europe.
So that ability to put an insurance policy into portfolios is quite important in understanding the way that 7IM manages money. We are broadly diversified. We are looking at the medium to long term. We are trying to produce expected results for clients. And very importantly, we try to manage against adverse outcomes, and this indeed was one of them.
Absolutely. So on the night of the results itself, the initial groups that came out were still suggesting that Remain was going to be the outcome of this vote. And in fact, Gibraltar, which was one of the early results, had a 95% vote towards Remain. So at this point, the pound was actually still improving throughout the night and hit 150 at its high. Now, Sunderland was the turning point. That was the voting region where actually Leave started to show a bigger majority. They voted 61% to Leave, and that was bigger than had been expected from that region. At this point, we saw the tide start to turn on the pound. It dropped to 144, about a 3 to 4% move in the space of minutes. Now, our investment team were actually working throughout the night and were able to react very quickly to the movement in the pound. The slide you have in front of you now actually shows Chris's notes from the evening, and we've highlighted there going to be a rocky night, question mark. Probably in hindsight that should be an exclamation mark.
Rightio. Well, that paints a very clear picture of how political events can influence markets and have done in the very recent weeks. It's not just a UK event, this issue of politics affecting markets. You've got the possibility of Mr. Trump showing up in Washington. We have the prospects of Venezuela really going bankrupt. We have the prospect of Dilma Rousseff in Brazil being impeached. We've got the UK characters that you can see there. The populist votes represented by Marine Le Pen sitting over France. The big job that Angela Merkel has to do in trying to make sure that Brexit does not become an event which negatively impacts Europe. We have the events of last weekend in Turkey with the attempted coup. We have Mr. Mugabe, 92 years old, hanging on in Zimbabwe, probably more importantly in Africa. We have a very serious situation in Nigeria, where the oil revenues have halved because the price of oil is halved. But not only that, the corruption and diverting of oil revenues is causing real problems and threatening Africa's largest economy. Mr. Putin has been present in the headlines for the last year or so. with his endeavors in the Ukraine and elsewhere. And of course, we have Mr. Z, who has recently been in the news with regard to China's policy on the South China Sea. So we have multiple potential flashpoints around the world, and our point simply is that in addition to watching what we normally would watch, which are macroeconomic indicators and market indicators, we also need to keep a very keen eye on politics these days, because we're looking at something which is possibly more volatile than we've seen before.
Chris. So, following on from what Tom mentioned initially, which is unexpected outcomes, we don't need to look much further than Whitehall for the very definition of this at the moment. It's like an episode of House of Cards over the last few weeks. Interestingly, in the UK, politics affects the markets a lot more than it does, or it seems to do more globally. And what we've had with Theresa May coming in actually is a calming effect on the markets. There's a few reasons for that. Firstly, Article 50 has been deferred. She also had a meeting with Nicola Sturgeon recently as well, which seems to have shored up relationships for the time being where Great Britain is concerned. She put a cabinet in place and been quite shrewd in putting people from both the Leave and Remain sides of the campaign in that cabinet in front bench positions. There's often been a lot of talk from Theresa May in the run-up about the easing of purse strings, which should also be departing slightly from what George Osborne has said from an austerity point of view, which is a tick in the box from the market's perspective. And also she's gone to meet Angela Merkel today, in fact. So the early moves that Theresa May and I suppose having some kind of certainty there where the government's concerned have been a real positive. I think lifting up the bonnet rather, and looking at some of the economic fundamentals, which is the bits and pieces that we always do have to keep an eye on regardless of what is going on with the politics, is that initially in this regional event, as we mentioned, there has been an impact on the UK economy, and certainly from a forecast perspective as well, there's perceived to be an impact on confidence and spending going forward. Really big contributor rather to the UK economy is how much confidence people have, whether or not they're going to go out and spend money, and whether or not they're therefore going to increase the velocity of money going around the economy. And what we can see here is that real household disposable income is expected to fall over the next couple of years, partially because inflation is expected to tick through, but also because unemployment is expected to tick up marginally as a result, which then does have a knock-on impact. A thing that we're asked often an awful lot about as well is the housing market in the UK and the impact of the uncertainty as a result of the referendum there. And since the referendum, the perceived risk of lending to banks is higher. So this means ultimately that they have to pay more to borrow, which then in turn means that the cost is passed on to us. So forecasters predict that mortgage rates will rise as a result, and you can see that light blue line there just ticking up, reflecting that. So that's not following interest rates going down. Finally, from an overarching point of view, the vast majority of institutions have been predicting in the run-up to the referendum, as well as afterwards, a negative impact on UK's GDP. So GDP, I suppose, being our output. And the IMF indeed yesterday cut projections for UK growth by another %, so that very much still remains. What we can see from this chart here is anyone going to the left, that's the extent of the drag on growth rates that's been predicted by a number of those institutions. So the range does differ, with one notable exception that is expecting a bump, so a positive impact to the UK economy, and that is economists for Brexit, somewhat unsurprisingly.
Yes, interesting that. Well, Chris, thanks very much. We need to be careful in managing a global portfolio not to have too insular a view. So we always thought that if Brexit came to be a reality, that there would be at least a short-term negative impact in the UK. That still seems to be the consensus view. However, UK is a very small part of global GDP. Hen, talk to me a little bit about Europe, and then we'll move to the rest of the world after that.
So one of the big question marks over the result of our referendum is, are we going to see similar referendums within other EU countries? The map you have in front of you now shows the degree by which some of these far-right parties, the ones that would love to come out of the EU, actually have a sway in what's going on in local politics within the countries. Now, the darker the colour, the more influence they have, and what you can see from the map is that it's only the Netherlands and Austria that are really in a position where we may well see a referendum, but probably that's at least a year off anyway. So the bulk of Europe broadly have governments in place that have a consensus view of what's going on in the EU. And actually the reaction from most of those countries when our referendum result was released that we were a bit mad.
So very, very important for us to draw the conclusion here that at this point in time, at least, Brexit appears to be a localized event, not a global or systemic event, and that will indeed be one of the key decisions in managing your money going forward. So if we have a non-calamitous situation, if I could put it that way, in Europe, let's look over to the other side of the pond, Chris. What's going on in the U.S.?
Well, we're still a little way off the US election, that's in November, but the serious stuff starts in September when the formal election process actually begins. One thing to note is that depending on which of the polls that you actually look at, Hillary Clinton is emerging as the favourite. And a Trump victory, disregarding his actual policies and some of the rhetoric there, could surprise and mean a bit of volatility for the markets. And actually what this graph demonstrates quite nicely is the divergence between the Democrat policies on the left and their kind of position, I suppose, and their thoughts on what should happen within the economy and within the US versus the Republicans on the far right. So there's quite a big divergence there. Hence, if there was, in inverted commas, a surprise and Mr. Trump was to get in, it could mean a knock-on effect to the market. So I suppose the big question for us, and what we'll be watching very closely, is the potential impact on the dollar.
So that's the political side of the U.S. Economically, what's going on over there?
Well, we're actually quite positive on the outlook for the US. The recovery seems to be gaining momentum. Valuations are nearing all-time highs for US companies. Jobs data, which is a really good indicator of the health of the US economy for June, significantly beat expectations. That's a really big tick in the box. And the US consumer as well is ploughing ahead and sentiment is seemingly high. What we've actually got here, the Citigroup US Economic Surprise Index, great name, basically measures whether data that is released beats or misses rather expectations. Since June, you can see on the far right hand side of this chart, there's actually been a big surge, and that shows that continually strong data is pouring out of the US and beating expectations, which is not only good for the US, but it's a good sign for the global economy.
So very important for us in deciding how to manage the money. The US consumer, which is probably the largest single component of global GDP, is actually looking pretty healthy right now. Now, moving from the U.S. to Japan, we've seen Japan sort of caught in a malaise for a couple of decades now. Give me an update on what's going on there, Chris.
Well, Mr. Abe has won the upper house election rather convincingly as well. And this wasn't just a vote for Abe, but for his policies as well. So Abenomics, you've got the three arrows in the bottom right-hand corner here. It's not just from clip art, it does symbolise something. The three arrows of Mr. Abe were structural reforms, monetary policy, so the easing monetary policy, and the easing of fiscal policy as well, so government spending. Now, it does have an impact that Mr. Abe has got in, because it means that he can push ahead with both the reforms he wants to. Quantitative easing and the monetary policy is something we've seen for a few years in his initial term, but the fiscal stimulus, which we've been waiting for a while, he can now plough ahead with, and that's a positive because then it's a boost to economic growth.
So even though they've had real economic challenges in Japan, and they continue to face them, not the least of which are demographics, because the LDP controls all parts of government and the central banker is sympathetic to the policies of the LDP, at least they will be able to engage in stimulative policies without political backlash.
And strong public support.
Okay. So questions on the economics in Japan, but supportive politics there. China, lots and lots of noise over the last couple of years about China. Recently, we've seen China in the headlines in terms of the South China Sea. Give me a little political and then economic comment on China, please.
No problem at all. So the dispute you mentioned is over territory and sovereignty in the South China Sea. So that's between most of all, there's a number of countries involved, but China, the Philippines and Vietnam. And the Chinese military at the moment are actually completing military exercises this week. So there's quite a lot of chest thumping going on is probably the best way to describe it. Now, global political efforts, from our point of view, seem to be working. The Hague's ruling most recently has said that China doesn't actually have a claim to the area. So we think there's a lot of bluster there, but the big question will be, will China ignore international law or not? Certainly from our perspective, we don't think this is going to escalate into a conflict and common sense will prevail, but certainly a lot of saving face at the moment and, as I said, beating the chest.
So in the absence of the threat of military conflict, back to the economy, what's going on with the Chinese economy? Are we going to see this feared hard landing, or are they going to be all right?
Well, it's conspicuously failing to materialise at the moment, and what I would say is that China were front and centre last year. They were the catalyst for the the tailspin that the markets fell into, and even small movements in their currency seemed to kick off all kinds of carnage in the equity markets. But actually, the data doesn't look too bad. When you look at industrial production, so that's beating expectations. We talked about how if you beat expectations and forecasts, it's a real positive. They've done that both in industrial production and in consumer spending. So we're seeing that rotation towards that service sector we've been predicting for a while now, starting to come through. Interestingly as well, the Rust Belt, which is the area that China really do rely on, the manufacturing, the export of goods to the rest of the world, they've seen an improvement from the commodity prices, which has supported them, as well as a weaker renminbi, which is their currency. That's the weakest it's been since 2010, so really good for exporters. And interestingly as well, it's important to note that that's weakened without causing the ruptions that we saw in the market last year. Couple of things I suppose to watch out on the horizon, which is the level of debt they've got and the fact that government spending is ticking up, but not all bad in China.
You're painting a picture of stability in China. You're painting a picture of at least unified stimulus efforts in Japan. On the back of rising commodity prices, emerging markets have been a bit more solid than they were earlier in the year, and the U.S. is also looking pretty healthy. So outside of the U.K., and Europe, the sky does not appear to be all falling in. We do need to be conscious of valuations, however. So Henrietta, in the midst of that kind of global quick overview, how do we actually manage the money?
Yeah, so as we pointed out today, there is a lot of political noise out there, and we need to both be aware of that and the underlying economics. So to sort of take you back to the starting point, we run here a very strong and robust process within which to actually manage clients' money. We start off with 4 key risk profiles, and within those risk profiles we have a neutral weighting towards different asset classes. This is based on analysis of a large amount of historic data to come to these numbers. So this represents where the portfolios would stand if all of this noise wasn't going on in the background.
So if I can just draw people's attention, for a balanced, which is sort of a middle-of-the-road risk profile, we would be trying to produce on the order of 6% per year return for people.
Correct, over a long-term view. So that's sort of the starting point of the theory. Now, to drill down a little bit more in terms of what that looks like from a diversification point of view, if we look first at the neutral asset allocation for that balanced portfolio, big point to highlight here is only 1/3 of the assets are actually in the UK. So even on a neutral view, we have a significant exposure to other areas around the world. And of course, on top of this, we overlay our short-term tactical views so we can change this composition of geographical exposure over time.
So neutral and tactical views, if I get this right, the neutral position is based on history and what would have been a great portfolio for yesterday.
Correct.
And the tactical view takes into account what we think is going to happen next.
Correct, yes. Same can be said for currency. Currency is becoming an increasingly important point of investment portfolios. We've seen this over the Brexit referendum, that the pound obviously moved around both in the run-up and in the days afterwards, and the dollar itself is a question mark in terms of where the US election moves to. So currency, as I say, really important part of the portfolio. Again, on a neutral view, we're just over half of the portfolio in sterling. Now that's from the UK weighting on the previous chart, because some of the asset classes we invest in, we would theoretically hedge back into sterling. So that's why we have a slight discrepancy here on the numbers.
And things like US Treasuries.
Yeah, and global government bonds, things that would automatically be hedged back. So slight differences there. But again, the key takeaway is our portfolios are not just about the UK. They are very much global portfolios.
So the purpose in having the majority of the portfolio denominated in sterling is to limit the volatility or how much it jumps up and down, yeah?
Yeah, and obviously most of our investors have sterling-based liabilities, so it's still an important currency to them for their day-to-day lives.
Okay.
Now, as part of the process in terms of where we get to today for the portfolios, we hold a quarterly asset allocation committee meeting. That committee comprises both members of 7IM, but also external members from the wider financial services community, including economists, other investment managers, and actually academics as well. It gives us an opportunity to have a think about our own internal views, but also sense check what's going on in the world elsewhere and get views outside of these 4 walls. What we do at the end of the meeting is present to the committee 4 different scenarios. So these range from a very good scenario whereby all the data is beating expectations, it's surprise on the upside, down to a scenario where really all of these potential risks come right to the fore. Now, the numbers you have in front of you are the latest round of scenarios, surfing and swimming being the top 2 positive ones. We're in summer, so we've got an aquatic theme. And at the point of time that the committee meeting took place, 71% of the committee members voted for those top 2 scenarios. However, it is worth noting that this took place before the referendum result was announced, so we need to factor that in when we think about how we're positioned today.
So the assumption of the committee would have been a Remain outcome, so you can infer, at least for the UK and Europe, a slightly more cautious approach than would have been the thought going into the meeting.
Yeah, and that's very much reflected in the positioning that we have today. So not too surprisingly, within the UK equity space, we're still very underweight where we would be on a long-term neutral view. In fact, we're avoiding that mid-cap part of the market that Chris talked about at the beginning that is very domestically orientated. We are a bit more comfortable holding the UK large cap exposure, the FTSE 100, which, as we've mentioned, is much more global in nature. We've also reduced our exposure to European equities. There is a potential knock-on that if the UK economy does start to suffer, as economists are predicting, that this is going to have an impact on Europe. So really reduced and favour underweight or reduced positions there. The parts in the world that we're still happy to have overweight positions to are the US. We've spoken about the strong economic data coming out of there, and also Asia. You know, we are very positive on the outlook for China, and of course the Asian nations around China that trade with them should benefit from that positivity as well.
And interestingly, the shares in China that we can invest in, the 8 shares, have the most attractive valuations of probably anywhere on the globe.
Yeah, so moving on to the fixed income space. Now, this is a part of the portfolio that proves a little bit challenging for us at the moment. We've seen very low interest rates around the world in most of the major economies, and of course that pushed investors into other asset classes in search for yield. Now, there's an inverse relationship between yield and actually the price of fixed income securities. So in many cases we've seen a push up in the price of these assets, but you're not actually getting rewarded by the terms of the actual yield that you're receiving. So it's very difficult for us to find opportunities in the fixed income space that we actually feel comfortable holding.
So if I'm looking what I'm seeing here, we still have exposure to governments, probably for safety reasons.
Correct, yes.
Not so much for the corporates, because it appears that the value there is gone. But some of the high yield, maybe some value is still there.
Yeah, so there are opportunities within the fixed income space, but we're having to be quite selective.
Okay, so if the core fixed income doesn't do the job that it would normally do over the longer term in a portfolio because prices are so high and yields are so low, how do we diversify?
So we have what we classify as our other or our alternatives portion of the portfolio. So these are investment ideas that are outside of the equity and the fixed income space. Often the return profiles that you see from these investments are completely unrelated to what's going on in the equity market and bond markets. Now, some of the aspects of the portfolio here are there for protection. We've got gold in the portfolio. That was another good insurance policy for us in the weeks that passed after the referendum itself. But it also acts as a hedge against inflation. And one of the things that we have been saying this year is we think inflation is going to be a problem for the US. So it's actually acting in 2 ways. We have got strategies in there, such as our Zebra Global Neutral strategy, which is designed to deliver a return that is not in line with what's going on in the equity market. So diversification really the key here. The one thing I would like to note is there's been a lot of press at the moment around property funds closing and not allowing investors to redeem. We don't hold any of those open-ended property funds. We're actually not allowed to hold them in the structures that we use. And the property exposure that we do have is through funds that can be traded daily and therefore have daily liquidity.
Okay. Well, that's a wonderful canter through the diversification that we have in the portfolios, and we're diversified on purpose. In terms of what we're trying to achieve, the expected return that Hen referred to is the orange line, which is about 6% in a balanced portfolio. And what we put up here is what's happened over the last several years to the actual portfolio, and this is after costs. So just to give you an idea of how it is that we perform, what we're trying to achieve is that average of 6% return, and it's doing more or less what it says on the tin, which is just exactly what we're looking for. Now, conscious that we've now taken a half an hour, and a half an hour is normally what we like to confine ourselves to. We have a couple of questions that have come in from the audience. One of them, maybe because of my accent, is, Tom, what is the average American view on Mr. Trump? Well, I'm not sure there is an average view of Mr. Trump because they're pretty polarized. He's kind of a Marmite type individual. You either love him or you hate him, and the polls would indicate that a fair few people do like Mr. Trump. I think what he's been very good at doing is appealing to the emotional side of the voters, those people who don't appear to have done well since the global crisis of 07 and 08, and those people who feel that the government really hasn't done a lot to help them. So he's had a very emotional appeal to that portion of the population. There are equal numbers that would view him as a real difficult person to have in the White House, A, because of his demeanor, and B, because of his inexperience, particularly in foreign affairs. So I don't know that there's an average, well, I do know that there isn't an average view of Mr. Trump. It's either one end of the spectrum or the other, and whether or not Hillary, with a much more centrist appeal, can become more popular is what we look forward to seeing over the next couple of months. So between now and early November, we will be watching that very keenly because that will have an impact on your portfolios and in particular on the dollar.
Thank you, Tom. I've got one in, I think, for Chris or Henrietta. I'll pass it over to you. A difficult question, but be brave. Where is sterling going?
Well, you can see in the tactical changes that we've made within the portfolio, we have just tilted back towards sterling, away from what was an overweight dollar position more recently. So incredibly difficult to guess. It's much like asking what was oil going to do a year and a half ago and trying to make speculation and make guesses where that's concerned. But what we can do is go back to the structure and the process and look at exactly where the dollar has got to against sterling and how far it's fallen to date, and then make tactical changes around that.
Well, what we have been doing, as Chris said, is in the last week adding money back into sterling and away from the dollar. Sterling is now at a generational low in value, and as Chris has also said, we've seen that the early moves by the new government headed by Theresa May have been moves to calm the market, and the early indicators from Downing Street are that the policies that they're likely to pursue will be sensible, will be negotiated, will be non-emotional to the extent possible. And so the early indicators are that this may be a well-managed process, the process being Brexit, and therefore our view is we are gradually moving money back into sterling so that if we do normalize, that you might see sterling another 5 or 7% higher than where we are now.
Next question. Apart from liquidity concerns, why isn't 7IM exposed at all to infrastructure? So infrastructure really runs off of interest rates. And where we are on the interest rate cycle right now, as Henrietta said before, is we're way down the bottom. And so like utilities, they are very expensive right now because they have represented yield in an environment where yield is hard to get. So one, valuation, they're looking pretty pricey. And as you said, liquidity is very important to 7IM. And that became evident to us also on the property side. Henrietta, you might want to comment on that.
Yeah, I mean, I mentioned before that you know, we've seen in the press over the last few weeks that many of these property funds have basically said they're going to close their doors to redemptions. Now, normally for UK, or for retail investors, one of the things that investment managers need to be able to maintain is the ability to meet those redemptions. But of course, within property funds, you're actually buying a physical asset, and as we all know from our own homes, you can't just sell that overnight. So it is important when we're thinking about how we populate the portfolios that we make sure we use an appropriate underlying investment.
So liquidity is indeed important to us, and liquidity is one of those things that you don't need until you need it. and then you really, really wish that you had it, as we saw with the property funds recently. Well, look, we have no more questions, do we, Michael?
No, that's it. That's it, Tom.
Okay. We'd like to thank you very much for your attendance. We'd like to ask you to feedback to Chris and to Henrietta or to Michael any thoughts or comments that you might have on our way of trying to communicate to you what it is that we're thinking about the world and how it is that that's going to impact the investments that we make on your behalf. Thanks once again from all of us at 7am. Bye-bye now.